Okay, well, these are, of course, the stocks that are in focus because of news. But overall, with the markets under pressure, a lot of these pockets like banks could also move to the back burner this morning. That's the big topic at hand. What happened to the banks in the US markets overnight? Richard Harris, the Chief Executive Officer at Port Shelter Investment Management, joins us now. Richard, SVB Financial was the big talking point, right? The stock itself was down 60%. After what the company announced. But as we were just discussing a while back, perhaps it's more restricted to, the startup space, early stage businesses, because SVB is the biggest lender to those businesses. So maybe it's not a barometer of what's happening overall in the economy, but you tell us, what is your view on what transpired overnight? And in general, are you still cautious on risky assets like equities, or are you starting to nibble in a bit?
Well, I think we've got to be very careful exactly what assets we're looking at. SVG obviously is a bank or lending institution that lends to small companies, startups. That's obviously a very risky area. It's proved successful for them because, of course, there's been a lot of liquidity coming out from governments. There's been a lot of demand, then there's been a lot of returns coming from that sector. So it's pretty good up till now, but it is on the risky end of the business, and it is likely to be the kind of bank that's likely to see the stress coming in first of all. We haven't really seen much of a move from interest rates, from the interest rate rise so far in the markets, and it is probably time that we might see some stress in the financial markets and indeed maybe some defaults.
Oh, you're using the D word, Richard. That gets everybody very scared, right? So are you suggesting that this may not be an isolated incident? And I think that was a big fear last night, right? It just brings back those really eerie memories of 2007 and 8.
Well, the financial markets go from 0 to 100 instantly, and you don't really want to be in a bank which has some concern. You want to get your money out before everybody else. On the other hand, there may be very good banks which are extremely solvent that just have a liquidity problem. So I think we've got to remember that the market tends to look on a 0 to 100 basis. But in fact, these things occur on a continuum. So you've got to say SVG is at one end of the continuum, major global banks at the other end of the continuum, which are safe and secure, which are both solvent and liquid. And in the middle, there's a gray area where maybe some companies might default because there is a lack of liquidity around. That's the problem with the credit crunch. Yes, I think we need to start looking at the prospect of a default. All of the indicators are looking at that. But we need to face it because these things are going to become more frequent than they have in the past when high liquidity bailed them all out.
So Richard, just a follow-up question. If this thesis of defaults plays out, it might be in smaller companies, might be in smaller lending institutions. I don't know if it ends up being in private equity. Private equity has fueled a lot of this boom. Then what happens to the equity market? What's your base case scenario for the downslide, or can the market ignore all of this and continue to move on?
Well, I think, again, you have to put these things into boxes. The private equity market and the equity market are quite different in many ways. And the equity market moves instantly, it moves rapidly to where it sees the valuations are. Now, clearly, if there's a meltdown in the private equity market, that's going to affect equities overall. But I don't really see that happening. I think that there will be stress in private equity. Many of them have had a great run for the last decade or so. There's been plenty of money. There's been plenty of places to place your money. There have been lots of funds that have been set up. And there's been a lot of unwise investments too, as always happen when times are good. So some of them certainly are going to default down the line. I think what we would hope is that maybe private equity is not going to be as contagious as we might expect with listed equity. And that's partly, as I said a moment ago, because listed equity tends to react much, much quicker. And in many ways is a leading indicator of what might happen in the private equity market rather than something in parallel.
Hi, Richard. Good morning. Richard, suddenly everyone's been talking about the terminal rate heading towards 6%. Are you in that camp? What kind of Fed rate hikes you're working with? And maybe since this banking space suddenly goes into a bit of a tizzy, that could make the Fed a little bit cautious? Maybe slow down on the accelerator?
Well, the Fed has been really slow on the uptake all the way through. I mean, people are now just brushing off the whole thing with transitory inflation. Everybody knew that wasn't the case, at least anybody serious who was looking at the market. They were just playing a line, and they've been slow even before then about increasing interest rates. And the chickens are now coming home to roost. They are going to have to increase. Yes, I am in the camp where we're going to see somewhat higher rates, and we need somewhat higher rates because in Europe, inflation is pretty well double digit. In the US, it's still around 7-8%. In other parts of the world, hasn't quite caught up, or maybe the numbers haven't quite caught up. But inflation's there, and it'll have to be faced.
Okay, all right, Richard, final question then. A lot of our audience will be keen to hear your view on the Indian markets. And you've mentioned in the past preferences towards the Chinese markets, particularly on the valuation argument. How much more do the Indian markets have to correct to turn attention back to the Indian markets? Yeah, go ahead.
Yes, you're right. I mean, I have been focusing on the Chinese market, and unfortunately, it hasn't quite worked as a lot of people have thought. The Chinese market, there's a lot of, I think, more concern there. There's not as much confidence as we expected post-COVID, and if it hasn't really happened now, you have to wonder whether it will. There is a lot of new investment going in India as people are trying to resource. So I think India will be buoyed by that, by people continuing to move sourcing from China to India, but China will still be a very important area. But there will be some underpinning, I think, of the Indian market as a result.
Okay, all right. Well, let's see. For now, at least the markets are holding on to some crucial levels on the downside. Hope that sustains. Richard, thanks a lot for joining in and giving us your quick thoughts. So that is a cautious view coming in on the markets because of what's happening globally. Let's do one thing. Let's take a quick commercial break. On the other side, our entire research team will be joining in to help you prep for the day with our top 10 stocks. Stay with us.